Hi, Luke Fannin here again from AIT. We are about to start a past question on risk, and the last screencast looked at audit risk and just talked about three elements: inherent, control and detection. So when you're answering a past question, it may ask you to categorize audit risks into inherent, control and detection, or it may not. But sometimes, even if it doesn't, it's no harm to show that you know the difference. And if you're not sure, don't say it, but where you are sure, add it in. It improves an answer as long as you're correct. So they're what we discussed, the three types: inherent, control and detection. And now we'll move on and discuss we'll close the current tab, this past question here. So I'm ignoring part A. Just if you're answering part A, 5, state and explain 5 procedures. So 1 and 2, 10 marks in total, probably 5 marks going for part 1, half mark for stating a procedure, a half mark for explaining. And then for each procedure, describe an example relevant. So another 5 marks here for part 2. Make sure you would state and explain for 5. And then 5 examples, 1 example for each different procedure. Otherwise you lose marks. Now here we are on part B, on the required section. Using the information in this scenario, describe 5 audit risks and explain the audit response. So we're just today concentrating on describing 5 audit risks. So another way of asking that would be, say, identify and explain 5 audit risks. And you read through it and you see the things that are relevant. Just need to change the color. It's blue. I don't like the blue. The industry can be relevant if we're talking about inherent risk. You couldn't possibly talk about cyclical industry there if you were stuck, but you'd read through the rest of it and see what stands out. So you scan through quickly. Your audit senior, you start planning the audit. Now, does it mention that it's the first time that this is an audit client? If it does, that would add to detection risk. Or does it say that this is year 20 with your client? Then that would add to familiarity and that would affect detection risk, but it doesn't say either here. So then we have more detail here. So they're acquiring more airplanes. They've placed orders for 6 planes. Not sure received at year end. That's relevant. 15 million on refurbishment. A loan of 25 million. All of that seems relevant to when we discuss risks. Bookings from travel agents, 90-day credit period, and a number of them are struggling to pay. Well, there's a risk. They have a website, difficulties, customer complaints. And then in May they closed down middle-large workforce redundant. So there's a number of things there that we have highlighted. When you read them, it looks like risks. It's fairly common sense, this. Where people go wrong, and what I want to highlight is people then go on and explain, or students are people too. Students then often explain them in terms of business risk. So I'm just going to show you what not to do. So maybe I should show you what to do first, but I'm not going to do that. So if we look down here, I need to move this. So number 1 there, the company will need to acquire more airplanes. They've placed orders and the company's not sure whether they'll be received. So that's a risk, but this is described in terms of business risk. If the plane is not received, the company will not be able to make the flights. Students might say, or the company customers will be unhappy. They won't be able to expand. None of that's in terms of business risk. To describe an audit risk, the key thing is you have to be able to link back to a misstatement in the accounts. So when you're explaining or describing audit risk, you have to make a strong connection to a misstatement in the accounts. Do you remember we said audit risk is the risk the auditor expresses an inappropriate opinion when there is a material misstatement in the accounts. So I have their possible misstatement because it is possible, but I should have put material as well. So here, there's no real connection to the accounts. Number 2, they've spent 50 million refurbishing. So will the airlines be good enough? Will they, like when you receive the new planes, will the refurbished planes look, poor in comparison? Or will the right colours? All of these kind of things. Will the repairs be adequate? How do we know the engineers are qualified? They're all business risks, but no link back to the accounts. So we'll just look at those 2 described in terms of audit risk. So here it is, number 1. Still, this is the risks, what you'd write down. So if you're identifying the risk, you would say the risk is they're acquiring 6 planes for 20 million, not sure whether the planes will be received at year end. And the audit risk is risk of non-current assets being overstated. The planes, and the rule is planes can only be recorded as assets if they're received by year end. So that's the risk here, that the planes mightn't actually be received, yet the company might record 20 million in their non-current assets. What might they do? They might debit non-current assets 20 million and credit accruals perhaps for the payment if they haven't made the payment yet. You as auditor would need to check to make sure were the planes received. So there's the misstatement in the accounts. The next thing, number 2, the refurbishment, 15 million, very material amount. The risk there is to do with capital and revenue expenditure. So refurbishment, it's inherently a risky type transaction in that, there's an element of inherent risk and control risk here, in that inherently it can be complicated. There's a lot of case law about what qualifies as repairs and what qualifies as capital. And it makes a big difference, because if it's capital expenditure, it gets added to non-current assets. You debit non-current assets, you credit bank. If it's qualifies as repairs, you debit expenses and credit bank. So, it makes a big impact on the accounts. So that's why I said, so your non-current assets could be over understated, your expenses the same, over understated. So that's the risk for those 2. Number 3 and 4 are ones that do catch students, in that they, even though they might do other risks and explain them well, the going concern one tends to get them, because what students say is they might not get the money and could go out of business, or they might say they might not get the money, the company is not a going concern. That's the company could go bust. But they're still not saying what the misstatement is in the accounts. They just needed, so this is nearly right. What they needed to do was just rephrase that, or add a little bit to it and say the accounts could be incorrect, therefore, because the incorrect going concern assumption might be used. So incorrect going concern assumption in accounts, where the company is not a going concern but the director said it is, or else, directors should disclose material uncertainties about going concern in the notes to the accounts. So disclosure is the notes to the accounts, and auditors, it's important that they check that those disclosures, if they should be made, are made. Here we're back to business risk, and I said this is another one that catches people out. Anytime you see sales on credit to customers, so a 90-day credit period, which is quite long, and even if it didn't say struggling to pay, but it does, so it's really hammering it home to you, there's a risk that travel agents might not pay. So the company will lose money, will lose out on money. And that's the business risk. You need to link it to the accounts. And just for a moment think. So you need to say something about receivables being overstated, bad debts understated, bad debt provision inadequate. You know, the auditor would have to do a lot of work on the aged analysis of receivables, would have to recalculate provisions, concentrate on the oldest or the biggest amount of, if there's any particular individual travel agents that owe a lot of money, you know, a lot of work would need to be done to make sure that the receivables are properly valued. And of course, looking at post-year-end transactions to see if the receivables, if the travel agents pay. You know, they're responses that an auditor would do. We've issues here on the website, difficulties, customer complaints, and sold the seat, double booking of seats. So, you know, customers may not be happy, bad reputation, all of that is true, but none of it is linked to the accounts. So that's not good answer, it's poor answer, and you know, we'll get no marks. Here, students thinking maybe there's, you know, possible refunds due. You know, it's good, it's heading in the right direction, but it's not good enough. They need to expand that answer and link it to the accounts. So if there's refunds due, if there's possible refunds due at year end that haven't been paid yet, how will that affect the accounts? And how it would affect the accounts is in terms of, should there be a provision? So are provisions understated? Contingent liability, if it doesn't meet the rules for a liability or a provision in terms of the likelihood of the payout, and if the amount can be determined, then you're looking maybe at a contingent liability, which is just disclosed in the notes to the accounts. You know, so that's what should be discussed when you're looking at possible payouts in the future. So is the provision in the accounts for future refunds, you know, and you'd go on and talk about depending on which detail is there, but contingent liabilities versus liabilities. And on this, on the customers being unhappy, you know, tickets have been booked and paid for, Donald has no record of them. Customers will be annoyed, but really, the auditor doesn't care. What you're more concerned with is, okay, how does that affect the financial statements, the accounts? So if there's no record in the website, does that mean there's no record in the accounts? You know, the auditor would have to do a lot of work and go back and look at sales orders, any way of tracking the sales made and linking that to what is recorded in the accounts. But at the moment it looks like the sales figure in the accounts is incomplete. So this, to do anything to do with the website, would be control risk. You know, the website is major control in the company, so you'd be talking about control risk here because of mistakes or errors with the website. Donald no record. Okay, sold the seat to another customer. Bit of control risk, bit maybe inherent risk. You know, it's not so clear cut sometimes what it is in terms of inherent control or detection, but sometimes it's very clear cut. So, you know, say it then, even if you're not asked. And then we have a redundancy. When did it happen? It's important to look at these things in May. So when is the year end? 31st of July. So if it discussed this if it said it happened after July, so June, July, August or September, then you're talking about potential adjusting, non-adjusting event and the effect of that on the accounts. But it's not here because it's before year end. So in May they closed down, made the large workforce redundant. This is poorly stated in that no mention of the accounts. We don't care about staff if they're unhappy, if they're happy, if they're dead or alive, zombies. You don't mind. As auditor, all you care about is the payroll right for them in the accounts. You know, we don't care if ticket sales go up or down. The accounts will just record that. So we look at it in terms of the accounts and we say it's an unusual, complex event. A redundancy doesn't happen. You know, it could happen, not happen for 10, 15 years in a company. So it's unusual, it's complex, so it's inherently risky. So when we talk about inherent risk, this is up there, inherent risk. So there's a risk that it won't be recorded properly in the accounts. You're looking at liabilities. So it's you know, should there be a liability recorded? Do they know the amount of the payout? Because it won't all be paid yet, you would think. So possibly a contingent liability if they don't know the amount of payout. You know, you could mention these things in your answer. You know, and then there's, in respect of the auditor response, you'd be looking at, find out the rules and tax rules in relation to redundancies, go over the workings that the company has done in calculating their redundancy provisions or redundancy payouts to make sure that they're doing it properly. You would look at board minutes to see if this was, you know, communicated to staff before year end. You perhaps might look at payments out of the bank account for payments so far. Those are kind of responses you do. But the key thing is here that the risks are explained in terms of the accounts. So that's the big thing I wanted you to get here. You know, we could have even here spoke about the airline business, inherently risky. So there's a possible risk that, due to the fact that the airline industry is quite cyclical, you know, if you had wanted to bring in some professional competence, so if you were stuck, but you're not stuck in this question because there's, you know, there's 6 or 7, there's at least 4 or 5 fairly obvious risks here. They're the ones to talk about. If you were stuck here, you could talk about the inherent risk of the industry. If you could, you might mention maybe some airlines that have closed in the past. Monarch is, you know, a fairly recent one. And if we look here, we can see all the, you know, it's quite common for airlines to close. You don't have to do a list a lot of them, but one or, you know, would add to your answer. So you'd say the airline industry is notoriously cyclical, and, you know, airlines can close quickly. You know, Monarch was a recent one in the UK. That would really add to your answer. Then you say, therefore, there is a risk that the accounts may be prepared on the incorrect going concern assumption, or else there is a failure in the accounts to adequately disclose material uncertainties about going concern, that the notes in the accounts are, you know, are not detailed enough, that they're missing this material uncertainty. And the audit response would then be all about the auditor. How does the auditor check going concerns? So the auditor would be looking at their, oh, I missed about the bank, didn't I? The auditor would be check forecasts, look at board minutes, look at loan repayments in the future, what's coming up in the next 12 months, and that, have the company got plans to roll it over, have they got finance in place? All of the things that was done for Carillion but didn't uncover, or, you know, the going concern problem that was there in the company. But that, you know, the company will argue that those circumstances, you know, appeared after year end. So that's what the auditors probably argue too. But that's that question in relation to the audit risks. So thanks for listening, and we'll see you in class.